Bitcoin, often referred to as BTC, is the first and most well-known cryptocurrency. Created by an unknown person or group of people using the pseudonym Satoshi Nakamoto, Bitcoin was introduced in a 2008 white paper titled Bitcoin, a Peer-to-Peer Electronic Cash System. Since its inception in 2009, Bitcoin has revolutionized the financial industry, introducing the world to the possibilities of decentralized digital currencies. This guide delves into the intricacies of Bitcoin, covering its price analysis and predictions, the impact of Bitcoin halving, investment strategies, the underlying technology, and regulatory considerations. Bitcoin price analysis and predictions. Historical price trends. Bitcoin's price history is marked by significant volatility, with multiple dramatic rises and falls. Initially, Bitcoin had little to no monetary value. It wasn't until 2010 when Bitcoin started gaining real-world value, trading for just a few cents. Over the years, Bitcoin's price has been influenced by various factors, including technological developments, regulatory news, market sentiment, and macroeconomic trends. Early years 2009 to 2013, Bitcoin's price remained under $1 for most of its first 2 years. In 2011, it briefly reached $1 and then surged to around $31 before crashing back down to $2. First major rally 2013. In 2013, Bitcoin saw its first major bull run, reaching a peak of over $1,000. This was driven by increasing media coverage and the growing popularity of Bitcoin as a potential investment. Gox crash 2014. In early 2014, the collapse of the Gox exchange led to a significant price drop. Bitcoin's price fell from around $1,000 to below $400. 2017 bull run. Bitcoin experienced an unprecedented rally in 2017, skyrocketing from under $1,000 at the beginning of the year to nearly $20,000 in December. This surge was fueled by mainstream media coverage, institutional interest, and the launch of Bitcoin futures trading. Subsequent correction 2018. Following the 2017 peak, Bitcoin's price experienced a prolonged bear market, dropping to around $3,000 by the end of 2018. Renewed growth 2019 to 2021. Bitcoin began recovering in 2019 and saw explosive growth in 2020 and 2021, reaching an all-time high of over $64,000 in April 2021. This rally was driven by increased institutional adoption, macroeconomic factors like inflation concerns, and broader acceptance of cryptocurrencies. Factors influencing Bitcoin's price. Market sentiment, public perception, and media coverage significantly influence Bitcoin's price. Positive news can drive demand, while negative news can lead to sell-offs. Regulatory developments. Changes in cryptocurrency regulations globally can impact Bitcoin's price. For instance, news of favorable regulations can lead to price increases, while restrictive regulations can cause declines. Technological advancements. Upgrades to the Bitcoin network, such as the introduction of the Lightning Network for faster transactions, can positively impact the price. Institutional adoption. Increasing interest and investment from institutional players like hedge funds, companies, and financial institutions add legitimacy and drive demand. Macroeconomic factors. Economic conditions, such as inflation rates and currency devaluations, can influence Bitcoin's appeal as a store of value. Supply and demand. Bitcoin's fixed supply of 21 million coins creates a scarcity effect, especially as demand increases over time. Price predictions. Predicting Bitcoin's price is challenging due to its volatility and the myriad of factors influencing it. However, several models and analysts provide projections based on different methodologies. Stock-to-flow model. This model, popularized by analyst Plam, compares Bitcoin to precious metals like gold and silver. It predicts Bitcoin's price based on its scarcity stock-to-flow ratio. According to this model, Bitcoin could reach several $100,000 per coin in the coming years. Technical analysis. Analysts use historical price data and chart patterns to predict future movements. Key indicators include moving averages, relative strength index RSI, and Bollinger Bands. Fundamental analysis. This involves evaluating Bitcoin's intrinsic value based on factors like network activity, adoption rates, and technological developments. Expert opinions. Industry experts and financial analysts often provide price predictions based on their insights. Predictions can vary widely, with some expecting Bitcoin to reach $100,000 or more, while others remain skeptical of sustained high valuations. Bitcoin halving. What is Bitcoin halving? Bitcoin halving is an event that occurs approximately every 4 years, where the reward for mining new blocks is halved. This event is crucial to Bitcoin's economic model and its fixed supply limit of 21 million coins. The halving reduces the rate at which new Bitcoins are created, thereby reducing the supply. First halving 2012 reduced the block reward from 50 BTC to 25 BTC. Second halving 2016 reduced the block reward from 25 BTC to 12.5 BTC. Third halving 2020 reduced the block reward from 12.5 BTC to 6.25 BTC. Upcoming halvings, the next halving is anticipated around 2024, reducing the reward to 3.125 BTC per block. Impact of halving on Bitcoin's price. Historically, Bitcoin halvings have been associated with significant price increases. The reduced supply growth, combined with steady or increasing demand, tends to create upward pressure on the price. Pre-halving rallies. Bitcoin often experiences price appreciation in anticipation of a halving event. Post-halving effects. Following the halving, price increases can continue as the market adjusts to the reduced supply. The impacts can be seen months or even a year after the halving event. Long-term effects. Halvings contribute to Bitcoin's deflationary nature, which many proponents argue makes it a valuable store of value over time. Market psychology. And halving market psychology plays a significant role in how halving events impact Bitcoin's price. The expectation of reduced supply and historical patterns of price increases can drive speculative buying, further amplifying price movements. Bitcoin as an investment. Benefits of investing in Bitcoin store of value. Bitcoin is often compared to gold as a digital store of value. Its fixed supply and decentralized nature make it an attractive hedge against inflation and currency devaluation. High returns. Historically, Bitcoin has provided substantial returns for early adopters and long-term holders. Portfolio diversification. Including Bitcoin in an investment portfolio can provide diversification benefits, potentially reducing overall portfolio risk. Global accessibility. Bitcoin can be bought, sold, and used globally, providing financial inclusion to individuals in regions with limited access to traditional banking systems. Transparency and security. Bitcoin transactions are recorded on a transparent, immutable blockchain, providing security and reducing the risk of fraud. Risks of investing in Bitcoin. Volatility. Bitcoin's price is highly volatile, which can lead to significant short-term losses. Regulatory risks. Changes in government regulations can impact Bitcoin's legality and usage. Technological risks. While Bitcoin's blockchain is secure, vulnerabilities in surrounding infrastructure exchanges, wallets can pose risks. Market manipulation. The relatively small market size compared to traditional assets can make Bitcoin susceptible to price manipulation. Security concerns. Holding Bitcoin requires securing private keys. Loss or theft of these keys can result in the irreversible loss of Bitcoin. Investment strategies. Hodling. A long-term investment strategy where investors buy and hold Bitcoin regardless of market fluctuations. Dollar cost averaging. Investing a fixed amount regularly, e.g., monthly, to reduce the impact of volatility. Trading. Actively buying and selling Bitcoin to capitalize on price movements. This requires a good understanding of technical analysis and market trends. Diversified crypto portfolio. Investing in a mix of cryptocurrencies to spread risk. This can include other major coins like Ethereum, as well as promising altcoins.